Welcome back to the channel. Today we're breaking down Exicom Tele-Systems, a stock that's been creating noise, not because of a rally, but because it has slipped toward the lower end of its 52-week range. Is this a danger zone or a high-risk, high-reward opportunity? Let's dive in. Exicom is currently trading around 131, with a 52-week range of 129 to 295. The market cap sits close to 1,840 crore, and the sentiment is extremely cautious. Why? Because although the core India business is doing well, the consolidated numbers are getting pulled down by the company's global acquisition, Tritium. So you have a stock at a discount, with a story that's complicated. Exicom has two engines driving its business. Engine number one, the standalone India business. This includes critical power systems, telecom power, and domestic EV chargers. This part of the company is growing steadily and actually profitable. Engine number two, Tritium, the global DC fast-charging business they acquired. This is where all the pain is. It's currently loss-making, cash-intensive, and requires a lot of investment before it becomes profitable. So in short, India business equals stable and strong. Global business equals high potential, very high risk. Let's talk about the actual performance in Q2 FY26. At a consolidated level, the company reported revenue of 281.7 crore, EBITDA loss of 32.7 crore, net loss of 68.8 crore. Now compare that to the standalone India business. Revenue 228.4 crore, EBITDA 15.17 crore, profit 5.9 crore. This is a classic case of a good Indian business being overshadowed by a loss-making global acquisition. Short-term investors need to be careful. The consolidated losses, especially from Tritium, can keep the stock under pressure. Until the company shows improvement in Tritium's margins or cash burn, big rallies may not sustain. But long-term investors who can handle volatility, this might be an interesting story. If Exicom can turn Tritium around, reduce debt, and use its rights issue funds effectively, the company could be re-rated as a serious global EV charging play. And remember, India EV infrastructure is growing fast, so the domestic business alone has solid potential. Here's what Exicom has going for it: strong domestic business with consistent growth, rapidly expanding EV charging presence, diversified power solutions business, virtually no long-term debt in the India operations, global opportunity via Tritium. The company is building a foundation for long-term scale, but the cost of that growth is showing up today. And now the risks, which you cannot ignore. Tritium's losses are large and ongoing. High working capital needs, execution challenges integrating a global asset, possible future fundraising if cash burn continues. A slowdown in EV or telecom infra can hurt momentum. This is not a low-risk compounder. It's a turnaround plus expansion story. For short-term traders, the entry zone sits around 120 to 135, with a possible target of 160 to 200, and a stop-loss below 110. For long-term investors, accumulation between 100 and 140 makes sense, with potential upside toward 220 to 350. But only if Tritium's turnaround becomes visible. So that's the full breakdown of Exicom Tele-Systems, a solid Indian business wrapped inside a risky global expansion story. High risk, but potentially high reward if management executes correctly. If you found this analysis useful, hit like, comment your view on Exicom, and subscribe for more breakdowns like this.